As silver opens in the east, here's what the COT shows. A pattern is emerging, one that most analysts are either ignoring or completely misreading. While Western markets sleep, Eastern buyers are doing something they haven't done in decades. The Commitment of Traders report reveals a positioning structure. That has historically preceded only two outcomes: violent repricing or systemic delivery failure. The commercial net short stands at levels that would concern any risk manager, but the number itself isn't the warning. It's what's happening in the physical market. While that number stays elevated, registered inventory is moving in one direction, Eastern premiums are moving in another, and the gap between paper price and physical reality is widening by the week. What comes next isn't speculation, it's mathematics. And the mathematics are unforgiving. Welcome back to Financial Rewind. If you've been with us before, you know we don't chase headlines, we follow the data, wherever it leads. And if this is your first time here, you've arrived at a moment when understanding what's actually happening might matter more than usual. Do us a favor, would you? Hit that subscribe button. Not because we're asking for a favor, but because when the next phase of this cycle accelerates, you'll want a source that saw it forming before the crowd noticed. We've been tracking this quietly. Now, let's break down exactly what the data is telling us. When traders in New York close their screens and head home for the evening, something shifts. The clock strikes midnight on Wall Street, and halfway around the world, the real action begins. In Shanghai, Singapore, and Mumbai, the silver market wakes up. And for the past 18 months, observers have noticed something unusual. The price that silver trades at when Eastern markets open doesn't match the price Western markets left behind. There's a gap, a premium, and it's not small. This isn't a glitch in the system, it's a signal that demand in the East is outpacing what the West anticipated. While analysts in London and New York focus on futures, positioning, and technical charts, industrial buyers in Asia are doing something far more direct. They're buying physical metal. Not contracts, not derivatives, not paper promises, actual silver. And they're paying more for it than the global spot price suggests they should. This presents a problem for anyone trying to understand what's really happening in the silver market. Because the Commitment of Traders report, the document that every serious analyst examines each week, only shows one piece of the puzzle. It shows positioning in the futures market. It reveals who is long, who is short, and by how much. But it doesn't show physical demand. It doesn't show warehouse movements between continents. And it certainly doesn't show the premiums being paid in markets that operate outside the COMEX system. The COT report is released every Friday by the Commodity Futures Trading Commission. It breaks down market participants into three categories. Commercials, typically large institutions that use futures for hedging. Large speculators, hedge funds and money managers taking directional bets, and small traders, retail participants with limited capital. For decades, analysts have used this report to gauge market sentiment and positioning extremes. When commercials are heavily short and speculators are heavily long, it often signals a market top. When the pattern reverses, it often signals a bottom. But there's a problem with applying this framework in the current environment. The traditional relationship between commercial positioning and price direction assumes that all participants are operating in the same market. It assumes that a short position in New York can be easily offset by physical supply anywhere in the world. It assumes that arbitrage works smoothly, that premiums disappear quickly, and that inventory flows freely across borders. None of those assumptions hold true right now. Consider what's happening in real time. A commercial participant, let's say a major bank, holds a net short position in COMEX silver futures. In theory, this position is hedged. Perhaps they own physical inventory in a London vault. Perhaps they have offsetting long positions in Shanghai. Perhaps they've sold forward to an industrial customer and are simply locking in their margin. On paper, everything balances. But what happens when the industrial customer in Asia decides they don't trust paper settlements anymore? What happens when they insist on physical delivery and they're willing to pay a premium to guarantee it? Suddenly, that balanced hedge isn't so balanced. The commercial participant now faces a choice: deliver physical metal from their existing inventory or source it from the market at the current premium. Either way, the cost has increased. And if enough participants face this choice simultaneously, the entire positioning structure begins to shift. This is where Eastern demand becomes critical. China's photovoltaic industry alone consumes more silver annually than most countries produce. India's electronics manufacturing sector is expanding at double-digit rates. Southeast Asian medical device production requires high-purity silver in quantities that have tripled since 2020. These aren't speculative buyers. They're industrial users with long-term supply contracts, and those contracts are becoming harder to fulfill. So they do what any rational buyer does when supply is uncertain. They stockpile. They pay premiums, they secure multi-year agreements, and they stop trusting that the paper price will guarantee them access to physical metal when they need it. This is the context that makes the COT report meaningful. not because the numbers themselves predict the future, but because they reveal how exposed certain participants are if the physical market continues tightening. And right now, the physical market is tightening. Registered COMEX inventory, the metal specifically designated for delivery against futures contracts, has declined by over 40% in the past 12 months. That's not a rumor. That's documented data, publicly available, updated daily. Meanwhile, the commercial net short position remains elevated, not at record extremes, but elevated enough to matter. The question isn't whether this creates risk. The question is, when does that risk materialize? And the answer may depend on what happens when silver opens in the east. There's a document that lands every Friday afternoon. Most people scroll past it, some glance at the headlines it generates, but very few actually read it, and even fewer understand what it's really saying. The Commitment of Traders report isn't written for casual observers. It's dense, technical, filled with numbers that seem abstract until someone explains what they represent. But hidden inside those columns of data is a map of who is positioned where and how much capital is betting on which outcome. The problem is, most people read the map backwards. They see a large commercial short position and immediately conclude the banks are trapped. They see speculative longs piling in and think the squeeze is coming. They compare one number to another and declare the leverage is insane. But they're missing three critical points. First, commercial participants don't operate like retail traders. They don't take directional bets and hope for the best. They hedge, they spread, they offset across multiple markets and instruments. A commercial entity might be short 50,000 contracts on COMEX, but long 30,000 contracts on another exchange. They might hold physical inventory in London vaults that offsets their paper position. They might have sold forward to industrial customers at fixed prices, and their futures position simply locks in their profit margin. The net short number everyone obsesses over is only net within one specific venue. It doesn't show the entire balance sheet. Second, the COT report shows positioning, not intention. A short position doesn't mean someone is betting silver will crash. It often means the opposite. If a mining company produces silver, they sell futures to lock in today's price for metal they'll deliver next quarter. That shows up as a short position. If a manufacturer needs silver 6 months from now, they buy futures to lock in their cost. That shows up as a long position. Neither trade is speculative. Both are business decisions. So when analysts scream about commercial shorts being underwater or trapped, they're assuming those shorts are naked directional bets. In reality, most aren't. Third, the numbers need context. Let's do the actual math. Each silver futures contract represents 5,000 ounces. If commercials hold a net short position of 55,000 contracts, that's 275 million ounces. Sounds enormous. But compared to what? Total COMEX inventory hovers around 400 million ounces. Registered inventory, the portion available for immediate delivery, sits closer to 120 million ounces. So the net short position is larger than registered inventory, but smaller than total inventory. Does that mean there's a problem? Not necessarily. Because here's what most people miss. Not every short contract is demanding delivery. In fact, the vast majority never go to delivery. Futures contracts are rolled forward. They're cash settled. They're closed out before expiration. In a typical month, only a small fraction of open interest actually stands for delivery. Maybe 5%, sometimes less. So comparing the total net short position to registered inventory, as if everyone will show up demanding metal simultaneously, is misleading. It's like assuming every person with a bank account will withdraw all their cash on the same day. Technically possible, practically unlikely, unless something changes. And that's where the story gets interesting. Because there's a category in the COT report that almost nobody talks about: spreading. Spreading positions represent trades designed to capture the price difference between contract months. If the front month contract is trading lower than the deferred month, a trader can buy the front and sell the back. They're not betting on direction. They're betting on the gap between months narrowing or widening. This is a low-risk carry-type strategy. And right now, spreading positions in silver are significant. What does that tell us? It tells us that a portion of what looks like outright short positioning is actually part of calendar spreads. It's not directional exposure. It's structural arbitrage. So if you ignore the spreading category entirely, you overstate the directional short pressure. But here's the twist. Spreading works smoothly as long as the underlying market has sufficient liquidity and inventory to support it. If physical supply tightens enough, those spreads can blow out. The front month can spike relative to deferred months, and suddenly, what was a low-risk carry trade becomes a high-risk scramble. That's the vulnerability. Not that commercials are massively underwater on naked shorts, but that their sophisticated, hedged, spread-based strategies depend on assumptions about physical availability. And if those assumptions break, the entire structure shifts. This is why analysts who scream 300 to 1 leverage are wrong. The actual ratio is closer to 2.3 to 1 when you compare net shorts to registered inventory. Still notable, still worth watching. But not the cartoonish disaster scenario that generates clicks. The real risk isn't visible in the COT report. The real risk is what the COT report can't show. It can't show offsetting positions in London, Shanghai, or Hong Kong. It can't show private over-the-counter deals between miners and manufacturers. It can't show physical inventory held outside the exchange system. And most importantly, it can't show the moment when participants stop trusting paper settlements and start demanding physical delivery. That moment doesn't announce itself in advance. It reveals itself through behavior, and the behavior is already changing. Delivery demand during recent contract expirations has been higher than historical averages, not by a massive amount, but consistently higher. Physical premiums in Eastern markets remain elevated, even when futures prices pull back. That's not normal. That's a signal that the paper market and the physical market are starting to drift apart. And when those two markets drift far enough, one of them has to adjust. There's a number that updates every single day. Most traders never look at it, most analysts mention it, but don't track it. And most headlines ignore it completely. But for anyone trying to understand what's actually happening in the silver market, this number matters more than price. It's called registered inventory, and it's been falling, not crashing, not collapsing overnight. Just steadily, persistently falling. Registered inventory represents the physical silver sitting in COMEX-approved warehouses that has been specifically earmarked for delivery against futures contracts. It's the metal that's supposed to be available when someone stands for delivery. It's the backstop that makes the paper market work. And over the past 18 months, it's declined by nearly half. Now, here's where it gets complicated. There's another category called eligible inventory. Eligible metal meets all the specifications. It's stored in approved facilities. It's the right weight, the right purity, the right form, but it hasn't been designated for delivery. It's owned by private parties, banks, funds, wealthy individuals, and they haven't committed it to the exchange system. Think of it this way. Registered inventory is like money in a vending machine, ready to dispense immediately. Eligible inventory is like money in someone's wallet, technically available, but only if the owner decides to spend it. And right now, eligible inventory far exceeds registered inventory. So when skeptics say there's plenty of silver, they're technically correct. Total inventory looks adequate. But when buyers say there's not enough available silver, they're also correct, because available and owned are not the same thing. This distinction becomes critical when you consider what's happening on the demand side. Industrial consumption of silver isn't optional. A solar panel manufacturer in China can't simply decide to use less silver because the price went up. The amount of silver required per panel is determined by the technology, not by preference. An electronics factory in South Korea can't substitute silver in certain high conductivity applications. Medical device producers can't eliminate silver from antimicrobial coatings. These are fixed inputs, and the industries consuming them are growing. Global solar installations are projected to double by 2027. Electric vehicle production requires significantly more silver per unit than traditional combustion engines. 5G infrastructure deployment is creating sustained demand for high-purity silver in telecommunications hardware. None of these trends are speculative. They're already underway, and they're accelerating. So what happens when fixed industrial demand meets declining available supply? The market responds with premiums. In Shanghai, physical silver trades at a premium to the London spot price. In Singapore, dealers charge premiums that were unthinkable 3 years ago. In Mumbai, wait times for large physical orders have extended from days to weeks. These aren't temporary dislocations. They're structural. And they reveal something important about how the global silver market actually functions. Silver doesn't teleport. When there's a price difference between regions, arbitrage is supposed to close the gap. Traders buy where it's cheap, ship it to where it's expensive, and profit from the difference. In theory, this happens quickly. In practice, it doesn't, because physical silver has to move through a logistics chain. It has to be refined to meet local specifications. It has to clear customs. It has to be insured, transported, and stored. All of that takes time. And during that time, the premium can persist, or even widen. Right now, the premium is widening. That tells us something crucial. The arbitrage mechanism that's supposed to keep global prices aligned isn't working as efficiently as it should. Either the premium isn't large enough to justify the costs and risks of moving physical metal, or the available supply willing to move is smaller than the market assumes. Both explanations point to the same conclusion. Physical supply is tighter than the futures market is pricing in. Now let's talk about what happens during contract expiration. Most futures contracts don't go to delivery. Traders roll their positions forward. Speculators close out, hedgers cash settle, but some contracts do go to delivery, and the percentage of contracts standing for delivery has been rising. Not dramatically, not enough to trigger alarms, but consistently. 3 years ago, delivery as a percentage of open interest averaged around 2%. Last quarter, it averaged closer to 4%. That might not sound significant, but in a market where the vast majority of activity is paper-based, a doubling of physical delivery demand is noteworthy, because each delivery represents someone who doesn't want cash. They want metal. And when more participants start preferring metal over cash, the entire system has to adjust. Here's why that matters. The futures market exists because it provides liquidity and price discovery. Producers can hedge future output. Consumers can lock in future costs. Speculators provide the liquidity that makes both possible. But the system only works if most participants are willing to settle in cash. If too many demand physical delivery, the exchange has to source that metal. And if registered inventory is falling while delivery demand is rising, eventually the math stops working. Now, some will argue that eligible inventory can convert to registered if needed. That's true, but conversion isn't automatic. The owner of eligible metal has to agree to make it available. And why would they, unless the price incentive is sufficient? If they believe the market is tightening, they'll hold. If they believe premiums will rise further, they'll wait. If they're already committed to long-term supply agreements, they won't sell at all. So the assumption that eligible inventory is a safety valve depends on behavior, and behavior is changing. Large industrial buyers are no longer waiting for spot prices to dip before securing supply. They're locking in multi-year agreements. They're paying premiums above spot. They're building strategic stockpiles. This isn't speculation. This is documented. Major Asian manufacturers have publicly announced supply agreements extending through 2027 and beyond. Government programs in multiple countries have begun treating silver as a strategic resource, not just a commodity. The shift from just-in-time inventory management to just-in-case stockpiling has fundamentally altered demand patterns. And once that behavioral shift occurs, it doesn't reverse quickly. Because the cost of running out of a critical input far exceeds the cost of holding extra inventory. So even if prices rise, industrial buyers continue securing supply. That creates a feedback loop. Tighter physical supply leads to higher premiums. Higher premiums encourage hoarding. Hoarding tightens supply further. And the paper market, which assumes infinite elasticity, suddenly discovers that physical markets have limits. The question isn't whether this dynamic exists. The data confirms it does. The question is, how much further does it go before something breaks? Understanding a market is one thing. Positioning capital intelligently is something else entirely. Because knowledge without a framework leads to reactive decisions. And reactive decisions are where wealth gets transferred. So let's shift from analysis to application. What does someone actually do with this information? Not what should they hope for, not what sounds exciting. What should they do? The first principle is simple but uncomfortable. No one knows the exact timing. Not the analysts who've been calling for a squeeze for 5 years, not the skeptics who've dismissed every warning, not the institutions holding the positions, and certainly not the retail traders watching from the sidelines. Markets don't move on schedule. They move when enough participants change their behavior simultaneously, and behavioral shifts are impossible to predict with precision. So the goal isn't prediction, the goal is preparation. Preparation means deciding in advance how to respond to different scenarios, not during the volatility, not when emotions are high, now. In calm conditions, with clear thinking. Let's break down 3 scenarios. Scenario 1, silver continues rising. This is the scenario most people hope for. Price moves higher, physical premiums widen, delivery demand increases, the squeeze narrative gains momentum. What's the right response? Not euphoria, because parabolic moves don't last forever. They can go farther than skeptics expect, and they can reverse faster than believers anticipate. So the framework here is rebalancing, not selling out of fear, not holding out of greed, rebalancing. If silver doubles from current levels, it becomes expensive relative to other hard assets. That doesn't mean it won't go higher. It means the risk reward has shifted. At that point, a rational allocation strategy involves taking some gains, and repositioning into assets that have become relatively cheap. Not into cash, not into bonds yielding below inflation, into productive assets, energy exposure, industrial metals that haven't moved yet, income-generating real assets. This isn't bearish on silver, it's intelligent capital management. Because the goal isn't to own the asset that goes up the most. The goal is to preserve and grow purchasing power across multiple cycles. Scenario 2, silver moves sideways. This is the scenario that tests patience. No dramatic moves, no headlines, no validation, just time. Sideways markets are where weak hands exit. They get bored. They chase other opportunities. They convince themselves the thesis was wrong. But sideways, markets are also where positions get built. Because if the structural drivers remain intact, tight physical supply, persistent industrial demand, declining registered inventory, then sideways price action is simply the market digesting earlier gains. It's consolidation, not collapse. The framework here is accumulation during dips and monitoring during stability. If the 5 key indicators remain supportive, commercial positioning, registered inventory trends, Eastern premiums, delivery demand, industrial consumption data, then sideways price action is an opportunity, not a reason to exit. Scenario 3, silver corrects sharply. This is the scenario that separates conviction from speculation. A sharp correction feels like the end. The narratives flip, the critics resurface, the panic sellers capitulate. But here's what matters. Is the correction driven by a change in fundamentals or by a change in sentiment? If registered inventory suddenly surges, if Eastern premiums collapse, if industrial demand data weakens, if delivery demand falls back to historical norms, then the thesis has changed. The correction is structural. In that case, the appropriate response is to reduce exposure and reassess. But if the fundamentals haven't changed, if the correction is simply profit-taking, speculative liquidation, or margin calls forcing position closures, then the correction is technical, not structural. And technical corrections in structurally tight markets tend to be violent but brief. They create opportunity. Because while emotional sellers are exiting, rational buyers are entering. So the framework here is simple. Pre-decide the conditions under which a correction represents opportunity versus deterioration. Write them down, make them objective, remove emotion from the equation, then execute accordingly. Now let's talk about what to monitor on a weekly basis. 5 indicators matter more than price. First, commercial net positioning in the COT report. Is it expanding or contracting? Are commercials adding to shorts or reducing them? Expansion during rising prices can signal institutional concern. Contraction during rising prices can signal capitulation. Both are meaningful. Second, registered comics inventory. Is it stabilizing or continuing to decline? A reversal would signal that the tightness narrative is weakening. Continued decline confirms structural stress. Third, physical premiums in Eastern markets. Are they widening, stable, or narrowing? Widening premiums confirm physical demand exceeds available supply. Narrowing premiums suggest the arbitrage mechanism is working. Fourth, delivery demand during contract expiration. Is the percentage of contracts standing for delivery increasing or reverting to historical norms? Rising delivery demand indicates growing preference for physical over paper. Declining delivery demand suggests confidence in cash settlement remains intact. Fifth, industrial consumption trends. Are solar installations, EV production, and electronics manufacturing accelerating or slowing? These are the demand drivers that aren't price sensitive. If they're growing, physical demand persists regardless of futures positioning. Track these 5 indicators weekly, not obsessively, not emotionally, just consistently. Because patterns emerge over time, not in single data points. And when multiple indicators align in the same direction, that's when positioning becomes urgent. Now here's the final strategic point. Silver is not a religion, it's a tool for preserving purchasing power in an environment where currency devaluation is policy, a tool for capturing asymmetric upside if physical supply constraints force repricing, a tool for diversification away from financial assets that carry counterparty risk. But it's still just a tool, and tools are meant to be used, not worshipped, not hoarded blindly, not held regardless of changing conditions. So the intelligent approach involves allocation, not concentration, a percentage of wealth in physical silver for insurance, a percentage in productive assets that generate cash flow, a percentage in other hard assets that hold intrinsic value, and a willingness to rebalance between them as relative valuations shift. That's how wealth gets preserved, not through perfect timing, not through all-in bets, but through disciplined allocation, continuous monitoring, and emotionless execution. The data is available, the framework is clear. What happens next depends on whether participants act rationally, or whether they react emotionally, and in markets, the rational few tend to benefit from the emotional many. The question is, which side of that equation will you be on when the next phase begins? Because as silver opens in the east each day, the answer is being written, one transaction at a time.